Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to focus on an apparent contradiction in markets. Despite the surge in energy prices that we've seen year to date, it appears that the market is not pricing in some form of stagflationary shock, even at the margin, an expectation of higher inflation and lower growth, but instead is pricing in a combination of both higher inflation and higher growth. And we'll have a look at how that is reflected in equity markets, in commodity markets, and in bond markets across the globe, but again, in particular, in the US. To start off with, we're going to have a look at the latest update from Iran. And we've been tracking the number of tankers crossing through the Strait of Hormuz, and that has been picking up. The 7-day average is now sitting at about 20, and that's moving from east to west. From west to east, it's slightly different, but we're looking at the number of tankers leaving the Strait of Hormuz, and that number, as I said, has picked up and is now running just a bit below 10% of normal. What's driven the market lately, though, is an expectation that tanker traffic will get back to normal quite quickly. We can see that most explicitly through the betting market. If you look at what's currently priced in, there's about a 63% chance that tanker traffic returns to normal by the end of May and a 75% chance that it returns to normal by the end of June. And I think that goes some way in explaining the recent price moves that we've seen. If we now look since the war started, in fact, global equities are actually up 2.5%. And US equities are up close to 4%. It's quite remarkable, especially when you consider that oil prices still, since the war started, are up over 30%. And if you look year to date, it's also quite incredible. We've had a massive surge in energy prices, oil up 56%. But despite that, global equities are up 6%. And if you look at rest of world equities, they've outperformed the US. And if all you knew was the year-to-date moves, and you hadn't looked at the news headlines at all, you simply looked at a surge in oil, up 50-odd%, and other commodities up somewhere between 7 and 10%. And with that, equity markets, they were up between sort of 4 and 14%, depending on the market that you look at year to date, with a dollar that was flat. You wouldn't think, just looking at those price moves, that we had had a supply shock. Instead, you would think that this is an increase in demand. And it just suggests that what we're looking at the moment globally is an environment where markets are not pricing in a stagflationary shock, a combination of higher inflation and lower growth, but instead is pricing in a combination, especially relative to the beginning of the year, of both higher inflation and higher growth, as evidenced by good equity returns year to date and much higher commodity prices. We'll see this in the bond market soon, but before we get there, let's just have a look at inflation for the moment. We've now had inflation prints for close to 40 of the 50 largest economies for last month, and global inflation has picked up. Median inflation has picked up from 2.3% up to 3%. What's interesting is while inflation has picked up, long-term inflation expectations have diverged. In the US, the expectation, quite clearly in fixed income markets, is that while inflation has picked up now, it will shortly drop off. Whereas if you look in Europe, the expectation is that while inflation has picked up, it's likely to persist at a higher level. We can see that through inflation expectations baked into 10-year bond yields. It's a very interesting picture. If you focus on the US in particular, at the moment, US inflation is just a bit above 3%. The market expects, through the bond market, that inflation will remain at just a bit above 3% over the coming year, but then drop quite rapidly afterwards down to around 2% and stay at around 2%. So it's quite clearly the case that the market is pricing in a short-term increase in inflation in the US, whereas in Europe, the market is pricing in a long-term increase in inflation. So there's an interesting divergence there, and that probably relates to the dependence of Europe on the rest of the world for LNG and the consequence of high LNG prices for high electricity prices. And at this point in time, the market is implying that the recent surge that we're seeing in prices is likely to persist in Europe, and in fact actually will end up with higher inflation over a prolonged period. Just sticking with bond markets and having a look at price reactions across the globe, just like the equity market, the bond market doesn't seem to be pricing in a stagflationary environment. If it was, what we would expect to see is higher inflation expectations in bond markets across the globe and lower growth expectations. But instead, if we disaggregate bond markets across the globe, what we are seeing is, in the main, higher inflation expectations, with a few exceptions. And we can see that relative to the end of Feb. But at the same time, higher real yields. And real yields typically correspond with growth expectations. There's some periods where it might diverge due to liquidity, but what we are seeing across the globe is bond markets pricing in both higher inflation expectations and higher real yields, i.e. higher growth. And that ties in with what we're seeing in the equity market, which is a combination of strong equity returns while we've seen the shock to energy prices, again pricing in a combination of higher inflation and higher growth. And it's just interesting. One would expect, given what we've seen, for the market, at least at the margin, to be pricing in some concerns around growth, but that doesn't seem to be coming through, certainly not in the equity market or in the bond market. And part of the reason that might be for the US is the very strong reporting season that we're seeing at the moment. We've had close to 50 S&P 500 companies report for Q1, and the earnings numbers have been very good. The current consensus forecasts that earnings growth will be around about 14% year on year, which by itself is a very good number. The market is also apparently expecting more. The consensus forecasts that earnings growth over the coming quarters will accelerate to over 20% up year on year. And if you look at the companies that have reported so far for Q1, close to 90% have surprised on the earnings line, which is very high by recent standards. And in fact, if you look back over the last 25 years, that's the highest percentage that we've seen that's beating. Now, it is still quite early in the reporting season. Only 10% or so of companies have reported. But should that persist, this would be one of the best reporting seasons that we've seen in the past 25 years, which presents an interesting dynamic in markets. You've got this combination of what we've seen in Iran, and you would think would lead to lower growth, but at the same time, companies, particularly in the US, are reporting very good numbers, and analysts are extending that to very good numbers over the coming few quarters. And of the two, it appears that the information coming from companies is more important, certainly for markets at the moment, and as a result, we've seen very strong equity performance out of the US relative to what one might expect. And I think that goes some way in explaining why the market is not attaching a huge weight to the stagflation environment, but instead is actually attaching a large weight to an environment of higher inflation with higher growth. Just finally, on China, we've seen some numbers from China over the past week. The key leading indicator in our view for China is a series called Total Social Finance, and that series is about flat year on year, which suggests that growth continues at around the current pace. And the current pace is pretty good. Chinese GDP numbers have recently surprised on the upside. Chinese GDP growth looking at about 5% relative to the consensus of 4.8%. It's the first time since 2024 that we've seen an acceleration in Chinese growth. And that too may feed into the broader narrative of growth being quite resilient, if not accelerating, in an environment of higher inflation. And we're going to continue on with this theme over the coming few weeks and just tie in what that means for monetary policy and what we think that means for the outlook for equities too. Leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.